Walk into a bank with $50 and one version of the system greets you. Walk in with 50 million and it becomes a different world. Most people think a bank is just counters, cards, and ATMs. In reality, it is a social filter disguised as a financial service. The rules are rarely stated out loud, but the treatment changes fast when your money changes. Banks do not simply store money, they rank relationships. At the lowest level, the bank sees risk, fees, and low profit. At the highest level, it sees opportunity, influence, and future business. The same institution can feel cold and punishing to one person, yet smooth and helpful to another. This video is not really about debit cards. It is about how money changes your position inside the system. Once you see the ladder, you notice it everywhere. In the line, in the fee, in the phone call, and in the tone. Start with the basic truth. Banks are businesses. They reward profitable relationships, not need. To the bank, you are not just a person. You're an account size, a behavior pattern, and a revenue profile. How much do you keep there? How much do you borrow, spend, save, and invest through them? Those answers quietly decide how much attention you get. They also decide how much patience the system gives you. At the bottom of the ladder, you are managed at scale. The system is built to process you quickly and cheaply. At the top of the ladder, the logic flips. Human time suddenly becomes generous, flexible, and personal. So let's walk up the ladder step by step. Each level shows what the bank thinks you are worth. The first level is the financially fragile customer. This is the person living close to zero or sometimes below it. Their money comes in, then immediately goes back out. Rent, food, transport, and bills leave almost no breathing room. To this customer, the bank feels strict. A small mistake can become a fee, and a fee can become a spiral. You miss a payment by one day, and the system reacts immediately. That is life in the high-friction zone. At this level, support is often automated first. Chatbots, menu options, long waits, and policy language do most of the talking. The bank may still offer products here, but they're usually built around need, not privilege. That can mean overdraft protection, installment plans, or expensive credit. The language sounds helpful, but the economics can be brutal. A poor customer is often costly to serve and hard to monetize cleanly, so the system leans on rules instead of relationships. Notice the emotional texture here. You feel watched when you are weak, but ignored when you need flexibility. Even the space reflects it. Crowded branches, plastic chairs, and generic service desks tell you this service is standardized.
If you are flagged as risky, the system becomes tighter. Limits shrink, approvals slow down, and suspicion increases. This is where many people decide banks are heartless. But really, they are seeing the most industrial version of banking. When you have very little money, the bank feels like a machine, and machines do not do favors. The second level is the ordinary stable customer. This is the salaried middle, the steady, direct deposit world. This person may not be rich, but they are predictable. Predictability is one of the bank's favorite qualities. Here the tone softens a little. You get better credit terms, friendlier service, and fewer nasty surprises. But this is still retail banking. The relationship is decent, yet highly standardized. At this level, the bank wants your mortgage, your car loan, and your credit card. It wants to become your financial default setting. If you follow the script, the bank likes you. You get approved, offered products, and nudged toward loyalty. Branch staff may even recognize your name. But that does not mean you have real leverage yet. If something unusual happens, you still hit policy walls. The system is nicer now, but it still runs on templates. That is the middle-class banking deal. You get access, but not much customization. The bank sees you as a long-term consumer of financial products. Useful, respectable, and scalable. If you call support, you may still wait, but the outcome is usually more reasonable than for the fragile customer. This level feels normal because most people live here. But normal is not the same as favored. The third level is the affluent customer. Not billionaire rich, but comfortably above average and visibly profitable. This person keeps meaningful balances, spends heavily, and often owns assets. Suddenly, the bank starts listening differently. Here, you may enter priority or premier service. It is still mass market banking, but now with polish. The waiting room changes first. Softer chairs, calmer staff, and less chaos are not random design choices. A banker might call you back personally. Fee waivers become easier, and small problems suddenly become fixable. This is the first tier where relationship language becomes common. You are no longer just a user, you are a client. The bank starts offering more than basic products. Investment accounts, advisory meetings, and tailored credit conversations move closer. The bank is not being generous. It is protecting and expanding a more valuable relationship. Cards become status objects too. Better rewards, airport perks, and travel treatment signal that your spending matters. You begin to feel the system working with you instead of against you. That emotional shift is a hidden luxury of wealth.
But this tier still has limits. If your assets are decent rather than massive, the bank remains polite, not obedient. You may get a relationship manager, but that person may still be handling many clients and corporate targets. The important thing is that you crossed from generic treatment into selective treatment. The bank is now trying to keep you. Once the bank starts trying to keep you, your leverage begins to grow. Not unlimited leverage, but real leverage. That is the quiet power of being profitable. People return your calls faster when your money can walk away. The fourth level is private banking territory. This is where banking starts feeling less like retail and more like membership. Here, the customer is not just wealthy. They are wealthy enough to deserve dedicated infrastructure. A private banker is no longer just a salesperson at a desk. They are a gatekeeper, coordinator, and relationship asset. The environment changes again. Fewer lines, more privacy, better coffee, quieter rooms, and discreet service all become part of the package. What you are buying here is not just performance, it is insulation from friction. If a transfer gets complicated, someone handles it. If documents are needed urgently, someone chases them down. Even lending changes here. Instead of asking whether you qualify, the conversation becomes how to structure it. That is a major threshold. Poor people ask for permission, while wealthy people negotiate terms. Private clients may also receive access to specialists. Tax strategy, estate planning, business lending, and investment structuring all move closer. The bank stops acting like a storefront. It starts acting like a platform around the client's wealth. This level often includes prestige signals. Invitation-only events and curated networking reinforce the class separation. Notice what has happened by now. The bank is no longer charging you for being inconvenient. It is rewarding you for being valuable. That reversal is one of the biggest invisible divides in money. The same institution punishes scarcity and smooths abundance. Private banking also changes emotional posture. You stop feeling managed and start feeling represented. Representation saves time, reduces stress, and creates better options. That is why wealthy clients guard access so carefully. The fifth level is the ultra-wealthy world. Here, banking almost disappears into private infrastructure. This is the world of major liquidity, major assets, and multi-layered complexity. The relationship can extend into family strategy. The client may have companies, properties, trusts, and investments across different regions. A normal branch could never handle this cleanly. So, the bank becomes highly specialized. Teams, not just individuals, may serve the relationship. Now you're dealing with custom structures, large secured lending, and cross-border coordination. This is banking as architecture.
At this level, the bank may worry more about keeping you than evaluating you. That is a completely different power dynamic. The ultra-rich client can move money, relationships, and reputation at scale. A single departure can matter. That is why service becomes almost anticipatory. Problems are solved before they become visible. The ordinary customer experiences rules. The ultra-wealthy customer experiences exceptions. Not unlimited exceptions, of course, but far more room exists when the relationship is massively valuable. By this stage, the bank feels less like an authority and more like a service provider competing for elite capital. So, why does all of this happen? Because banking is built around profit density. A low-balance customer may create many service interactions, but little upside. A wealthy client can generate lending, assets, referrals, and retention. Banks allocate their best human attention where future value is highest. This is not moral, it is structural. That same logic shapes everything from credit decisions to office design. Space itself becomes a class signal. It also shapes time. Richer customers wait less because their minutes are treated as more valuable. The bank may never say this directly, but the hierarchy is visible in every practical detail once you know where to look. And this is not only about banks. Banks are simply one of the clearest places where wealth becomes social treatment. So what signals does the bank use? First, it looks at assets and balances. Second, it watches stability. Regular income, regular deposits, and stable patterns reduce friction fast. Third, it looks at product depth. The more of your financial life lives there, the more the bank cares about losing you. Fourth, it measures behavior. Late payments, cash stress, or erratic activity change the tone immediately. Fifth, it notices future potential. A growing business owner may be treated differently from someone with the same cash balance but no trajectory. This means treatment is not only about what you have today, it is also about what the system believes you could become. If you're trying to move up the ladder, remember this. Concentrated value gets attention. Leverage matters more than loyalty. Banks respect profitable options, not emotional attachment. If the bank feels warmer to rich people, that is not a personality difference. It is a business response to value concentration. Wealth buys smoother systems because smoother systems protect bigger value. So the final truth is this. Banks do not just hold money. They translate money into treatment. The higher you climb, the less the bank feels like a gatekeeper, and the more it feels like a servant. That is how banks treat you at every level of wealth.